Hey, what's up, everybody? Welcome back to Investing Sucks. And today we're going to be talking about REITs, and specifically one REIT that has become very popular amongst retail investors, and that is Realty Income, which is this one here. So, Realty Income has become noticeably cheaper throughout 2023. As we can take a look at their chart here, they've lost close to 20% of their value so far in 2023. And as a result of this, their dividend yield has become considerably more attractive. So we can take a look at what it is now, and we can see it's currently in the range of about 5.5%. And whenever you get a dividend yield that kind of starts to exceed 5%, then all the dividend investors start to come out of the woodworks and get interested in a company like this. So this specific company has gotten a lot of attention lately, which is why I want to take this video and take an in-depth look at this company. Now, for a quick summary of this company, they are a diversified, a large real estate investment trust, and that diversification is really one of their key selling points. And they are also, with that, a pretty large retail real estate investment trust. And that's what I've looked at here. This is a scatter plot that maps the dividend yield along with the market cap specifically for retail real estate investment trusts. And the one all the way at the top here, this dot right here, this is actually Realty Income here. So they are the largest one. And then the second largest one is this one here, which is SPG, that's Simon Property Group. And then after that, it's a pretty noticeable drop off in the market cap. We get all the way down here to one that's just under $12 billion market cap. So there's these two, which are by far the largest, and kind of the middle of the pack is Realty Income here when it comes to the dividend yield. Theirs is currently about 5.5%. We can see there's even some that are much higher than that, kind of in the 10+% range. But if we take a look at their actual strategy, or specifically what criteria they apply when they're looking for investment properties and also what tenants they're going to have, they pretty much detail it here. From a retail perspective, our investment strategy is to target large clients that have a service, non-discretionary, or low price point component to their business. Now, the reason they do that is because these are the so-called recession resilient customers, right? They have the low price point, which means they offer basically the cheapest stuff out there. So even if there is a recession and discretionary spending is starting to decrease because people have less disposable income, then their tenants sell essential things at the lowest price point there is. So even if there is a recession, their business model should still hold up because their tenants aren't really going to be affected by that. So let's scroll down a bit and actually look at who these tenants are, because they did say that they are diversified, but diversification doesn't mean they're just simply immune to the economy. They're still going to feel the effects of that. And to be honest, they're not even really that diversified. If we look at their grocery stores here, this is the you can see the breakdown by the different tenants they have. There's the grocery stores, convenience stores, dollar stores. So pretty concentrated in retail, and retail here makes up the vast majority of their properties. So see about 90% there of their total properties. So not exactly diversified, but they are, more resilient than other REITs out there because their tenants are, if we look at the actual customers here, Dollar General, Walgreens, 7-Eleven, Dollar Tree, discount stores like dollar stores pretty much. And that makes up a pretty large number of their total leases here. So that is one unique feature that you get with Realty Income is their actual tenant base, right? It's a very strong, a very resilient tenant base. And, this kind of strikes me initially from looking at them and what their key advantage is, because this is going to make them a less risky investment, but it also means, with less risk comes less potential reward. So this is a more stable one. All right, so that's kind of the unique features that we can see pretty early just from looking at this REIT. Now, before I go any further, I just want to zoom out a bit and take a quick 200-foot view of the REIT space as a whole and look back to how it has done so far throughout 2023. So what I've done is I've put together this custom chart here, which maps the total performance of real estate investment trusts. So this is all real estate investment trusts that are either Canadian or US listed, which is this turquoise line here. And it compares them to the S&P 500 or the SPY ETF, which is this purple line here. And they start from the same reference point, which is the same value at the beginning of the 2023 year. And we can see pretty clearly that REITs have actually very much underperformed the S&P 500, which the S&P 500 has actually done very good so far this year. And a big reason for that is because of the performance of large cap tech stocks like Nvidia, Meta, and those types of companies, which I talked about previously. Now, this doesn't account for dividends, right? And dividends are a big factor in how you get paid back as an investor in REITs. But even if you add the dividends to this, I mean, you're going to add, say, an additional 4% to this. You're still very much underperforming the S&P 500 so far this year. Now, this is a very interesting trend because for a long time, REITs had actually been outperforming equities. And a big reason for that was because interest rates were kept so low for so long. And because, when these companies purchase real estate assets, that's a big part of how these REITs are able to grow and, outperform the market and do so well is because they had access to extremely cheap sources of capital. They could get debt at interest rates of, say, 2, 3%, and they could buy these real estate assets that had cap rates of, say, 6%. And the difference between that is essentially the value that they're creating for their shareholders, which I'm going to talk about that in a lot more depth later on in this video, kind of how that whole relationship works. But the essence of it is capital was very cheap for a very long time, and the real estate investment trust business model heavily benefited from that. But now that's no longer the case. Interest rates have gone up a lot, and they're at pretty much a decade high at this point. So we're really at a crossroads with REITs, where what I think is what we're going to start to see is some of these weaker business models in the REIT space start to get exposed. Right. And some of the stronger ones are going to emerge, and it's going to become very apparent when the tide comes out, who's been swimming naked, basically. Now, what I was also curious to look at is which specific REITs have done well so far this year. Or this is looking at the past year, not just 2023, so into September of 2022 until now. And I wanted to see if there's any specific patterns in certain types of REITs that were doing well and certain ones that weren't. And there wasn't anything major. So this chart here, this is a table that I put together, which looks at again, it's all the real estate investment trusts, Canadian and US listed. I got their market cap, their dividend yield, and then what their return over the past year has been. And we can see, if we look at the worst performing ones, there's going to be quite a few of office ones in here, which this is a, recurring issue. Commercial real estate is, kind of an area that is starting to be avoided a lot more because it's harder to find tenants in those space just with, the increase in working from home. And then if we look at the ones that have done the best, this one here, Diversified Healthcare Trust, has delivered in the past year 76% return, which is, very strong for a REIT. And this does account for dividends, by the way. But again, no specific pattern, right? Because even here, there's an office REIT, right? Which the trend with these has been they've been performing extremely poorly, but this one seems to have made it out okay. Now, I don't know specifically much about this one, but the key point here is that there's kind of just a blend overall of REITs that have done well and REITs that haven't done well. So there's no real discernible trend, right? So I really think it just depends on the specific business model that each one is applying. What's unique about each REIT, and then, based on what you think is going to happen in the future with interest rates and everything, how does that affect that REIT specifically? So that's kind of a 200-foot view. Next thing I want to do is look a bit more in depth at Realty Income. So like I showed before, the current dividend yield for Realty Income is about 5.5%. And if we look at what the actual dividends that they've paid out over the past couple years in USD, we can see they've pretty much been consistently increasing their dividend. And they do pay monthly dividends, and pretty much about every quarter or so, they'll raise the dividend by a few cents per share. And currently they're paying about $3.06 in dividends per year. Now let's do a quick check on this dividend to see how sustainable it actually is. Now, with normal companies, the easiest way to do this is you can just look at their earnings, right? You just go to their earnings and you could say, okay, well, if they're paying 3.06 in dividends per year, what's their EPS? And we can look at this line here, which looks at the EPS. So 0.63 for the 6 months ended in the first half of 2023. So this times 2 would be about 1.2, and that covers less than half of what they're paying in dividends. But the problem is, for REITs, you don't actually use EPS. EPS isn't really that useful of a metric The reason being is because the largest expense for a REIT is pretty much always going to be this here, the depreciation and amortization. Because they own so many, high value fixed assets, they have to record such large depreciation amounts, which can really make the income seem artificially low. So what you use instead is a metric called AFFO, or adjusted funds from operation. This is pretty much the industry standard metric to use as kind of the income of what a REIT would be. Now, it is a non-GAAP metric, which means that companies do have some discretion, some leeway in deciding what they can include or exclude from AFFO. But because it is such a widely looked at metric, you have pretty good assurance that companies aren't going to do anything too out of the ordinary. And they're pretty much always going to show you a reconciliation of a GAAP metric to the AFFO non-GAAP metric so you can understand what's being included and excluded here. So generally, I'm okay with relying on it. And we can see here for the 3 months ended June 30th, AFFO per share was about $1. So if you multiply that by 4, you get $4. So $4 in AFFO, they currently pay 3.06 in their dividends. So that's certainly an affordable dividend on that basis. Now, another important thing to consider, because let's say, you're looking at REITs and you see this one that it's gone down a bit recently and now it has a 5.5% yield. You like that it's diversified. You like that it has a lot of high quality tenants that are probably going to be okay in a recession. So you want to lock in that 5.5% yield because you think it's, a pretty low risk yield. Well, something you should consider is basically the other options that are out there for low risk yields. One of which is going to be this chart here, which is the Treasury yield curve, right? So this shows basically US Treasury yields at different yields to maturity. So there is the 3 months, 1 year, all the way up here, which is 30 years. And it is a bit of an inverted yield curve at the moment. That's kind of been the case for a while. But the current yield on 1 year US Treasuries is pretty much the same as what the dividend yield is for this company. So if your goal is to, lock in that yield and you think that's an attractive yield, just remember as investors, what we have to do is consider the different options that are out there because we have to make decisions based on risk, right? And if we can get 5.5%, which is a risk-free investment essentially, then we should take that versus looking at the dividend yield of a company like Realty Income, which, does have a bit more risk associated with it because it's not the US government that's backing it. Now, obviously, the counterpoint to that is with REITs, they can also increase in value, right? It's not just about the passive income they generate. They also have the ability to increase in value into the future if management continues to implement a sound strategy, acquire high value properties, manage them well, etc. Which is true, but they could also decrease in value if management doesn't do that, right? And if we look at Realty Income, let's just look at their overall stock price over the last 10 years, right? And it's done pretty well. We'll look at 10 years here specifically, 7% compounded annual growth rate per year. You add, say, the 4% dividend yield on top of that, and you're looking at 11%. But compared to the S&P 500, it roughly aligns with the S&P 500. If not, there's some slight underperformance there. So again, you have to weigh your options, right? I mean, if you're satisfied with 5.5% dividend yield, then investing in Realty Income doesn't make sense because you can get that with some treasuries. But if you have a specific reason to think why Realty Income is going to outperform and do better than perhaps it has in the past, it outperformed the market, then it makes sense to actually look into a large individual position in this company. Okay, so with that, the next thing I want to look at is kind of, the formula, the value creation formula that Realty Income, has been following, and then look at a recent deal that they announced and apply that formula to it, which is this $950 million investment into Bellagio. So let's jump into that now. Okay, so now let's talk about how does a real estate investment trust actually create shareholder value, how you can, I guess, identify a solid REIT ahead of time, and how you can actually tell if a REIT is actually undervalued, the same way you would with just a normal company. And I want to talk about this because I feel that a lot of the time when we look at REITs, we can see them as kind of these mythical creatures where we just look at the past performance data and we can see how well they've done over the last 10, 15 years. And then we can just find a couple REITs out there that have solid yields. We do some basic analysis to make sure that they can afford those yields and they're not holding any, distressed assets. We buy a few of those and then we call it a passive income portfolio. And this style of investing can be very intoxicating because it feels good to receive monthly dividends. It feels like free money, and we can just set these arbitrary targets of what we want to hit someday in terms of, a monthly income amount, and then just hope that eventually we get there by following a dividend investing strategy. But what I would encourage you to do is to look past the dividend yield and evaluate REITs the same way you would a normal business, which is to actually understand the value that it creates and whether or not that is sustainable. So the formula that I have on screen is the basic way that you can do that. Now, if you've seen my videos before, you know that I talk a lot about this formula. It's the extent to which ROIC, or return on invested capital, exceeds the cost of capital. So how much does it cost a company to acquire funds, and how much do they earn when they go and deploy that in their business, right? That equals the value created. It's the same thing with REITs, it's the same thing with, just regular stocks. So instead of just talking about this all theoretically, I actually want to jump into it and actually show you the detailed calculation that you can do for Realty Income. And you can apply this to pretty much any REIT that's out there, right? So we're going to start off by looking at the cost of equity, right? Because we know businesses, they can finance their debt with equity, or they can finance their business with equity or debt. So what is the cost of equity? There's a few different ways we can look at it, right? So the total equity, which is their market cap, is about $39 billion as of recording this video. Again, their dividend yield is about 5.5%. One way we can look at this is we say, okay, well, they've committed to paying 5.5% in dividends to their investors. That's, in a way, the cost of equity, because that's the dividends that they have to pay. Another way that you can look at it is the capital asset pricing model, or CAPM method, which you look at the risk-free rate. You then take a market risk premium, usually around 8 to 10%. In order to calculate the market risk premium, you take the 10%, subtract the risk-free rate, so it's about 4.5% in this case, because we saw previously the yield on 1 year U.S. Treasuries is pretty much the same as the dividend yield. You then take the beta, which for Realty Income is 0.74. You multiply this beta by the market risk premium, and then you add the risk-free rate. You get a cost of equity under this case of 8.8%. I think in this case, though, I'm going to use this 5.5% because that is the dividends that they have committed to paying their investors, right? So it's a more like true cost for the business, if you understand what I mean. So let's go with that for this. So 5.5% for the equity. Now, if we look at their debt. So basically what I did was I just looked at their balance sheet, which is their balance sheet here. We can see the various sources of debt that they have. Now, again, the unique thing with REITs is they're pretty much always going to have a lot of debt, right? Because they own real estate assets. These are very easy to finance using debt. Banks are very willing to lend money to real estate investment trusts they've built a good relationship with them. They have a history of paying back the loan and, managing the assets well and continuing to acquire tenants and keeping the rents paid. So if they have a history of doing that, that's really a key competitive advantage for a REIT because banks are going to be willing to give them access to capital. Even if capital gets more expensive, like it has, banks are still going to be willing to do that. So they have a few different term loans, multi-currency and then unsecured. And then I've got the balance here as well as what the actual interest rate is that they're paying on that. And I've pulled all this from their most recent 10Q. So if you want to fact check my work, then feel free to do that. But here's all the numbers here. Their mortgage payable, $841 million at about 5%. Their largest balance here is their notes payable, about 16.4 billion, which actually has the lowest interest rate associated with it at 3.6%. And then a few other things, commercial paper, their credit facility. But in total, they have about $19.5 billion in interest-bearing debt. The weighted average cost of that debt is 3.78%. So two sources of ways that they can finance their business. Equity, which carries a cost of 5.5%. Debt, which is 3.78%. You then blend those together, which means it's about 1/3 debt and then 2/3 equity. We apply the different rates to that, and we get a cost of capital just under 5%. Now, this is subject to change, right? If interest rates continue to go up, then this is going to get higher. If they get a credit downgrade, then this is going to go up because their interest rates are going to get higher on their loans as well. But so you do have to monitor it going forward. It's kind of a calculation you would do every quarter with this company. But we have 5% here for the cost of capital. Okay, so what's their return on capital? Well, let's look at how much invested capital they have. And let's keep this super vanilla, right? Let's not do all these wacky adjustments for weird accounting things. Let's just look at how much they paid to acquire their real estate assets, which we can see on the balance sheet, $46.6 billion. Okay, so that's the number there. What about the return? Well, I mentioned before the preferred metric is the AFFO, adjusted funds from operation. As of the most recent quarter, it was $670 billion, which if we annualize that, so multiply by 4, we get $2.7 billion. And here's the backup, the proof in case you want to see that. So what's the value creation? Well, all we do is we take this number, this 2.6, we divide it by the $46 billion here, and we get an ROIC of 5.76%. So this does exceed their cost of capital, right? And the difference is 0.8%. So it's not a huge difference, but the fact that they are maintaining this shows that this company is creating value. They are finding opportunities out there to deploy the capital that they can acquire and create value this way. If they had access to unlimited investment opportunities and unlimited amounts of capital, they essentially have access to an infinite money printer, right? Because they can just keep doing this over and over, acquire capital at the 5%, deploy it at the 5.7%, and then pocket that difference. And that difference is the value they create for their shareholders. They just keep doing that. But that's not reality. What reality is there's limited investment opportunities that enable them to earn this ROIC that we have here. And they have pretty stringent requirements for what they require their tenants to have, right? As we saw, a lot of their tenants are specific type, right? Like dollar stores, low cost, value providers. So that's how I personally evaluate real estate investment trusts. I want to look at this equation and I want to see how large of a difference it is between these two metrics and how sustainable that is. And does the company offer something, unique, right? So now let's apply this to that Bellagio deal that we talked about before. So this is a very recent announcement. This is about a week ago. And basically they announced that they are investing $950 million in the Bellagio, which is, I guess it's a casino or something in Las Vegas. They're doing this alongside Blackstone. And it's a pretty big deal. And it's a joint venture and they are acquiring a certain percentage interest. I think it's something like part of it is preferred interest units, some of it is an equity interest. It's a bit of a blend of both. But yeah, so they're getting into the gaming space. It's kind of unusual for them, right? Because as we saw before, all their tenants, or a very large chunk of their tenants, are discount stores. So it's something that's a bit out of the ordinary, and Realty Income shareholders aren't used to seeing something that's like this. And it does signal a few things in my mind. And the market did not react favorably to this announcement when it came out. A lot of the investors didn't really appreciate it, and you saw that reflected in the stock price. It didn't drop a lot, but it did drop by a noticeable amount. So clearly, at least some shareholders of Realty Income were not okay with this deal, and they jumped ship from that. So I think for one, it's because the Bellagio, it's outside of their typical tenant, right, which is discount retail stores. This is a investment into a gambling entity, which is much more volatile and much more subject to changes in discretionary spending, like what happens with the economy, the recession, employment rates, and that kind of thing. So investors, they may not like this because it's an indication of the direction that they're heading in now, right? And if it's an indication that they have to make these investments to keep growing their asset base because they're having trouble finding other things to invest in, which are more of their legacy type of investments that they've been making, those are two things that are going to start to worry investors, right? Now, in terms of evaluating this deal, like we said before, we want to make sure that this company can keep deploying their capital at a rate that exceeds their cost of capital. If their cost of capital continues to go up, which it likely will, then they're going to have to, start charging more in rent. And one good thing to see with this deal was it did offer the ability for them. I don't know if it's going to say it in this article specifically, but they do have the ability to increase the rent that they're charging in the future. I think it was 2% for a few years, and then a few years after that, 3%. Or if the CPI is higher, then they can charge a higher rate, or they can increase by a higher rate as well. So with the rent that they're receiving from this, they do have the ability to increase in the future, but they're investing $950 million. So you want to see a rate of return on this of at least $50 million per year in actual income that they can distribute to their shareholders, right? Because then that would be more in line with this return on invested capital here. Now, one thing I wanted to show is this here, which is basically their cost of debt specifically compared to what it is now with current rates and what it was 2 years ago in 2021 when rates were lower. And it's not as big a difference as you might think. And I wanted to show this because, like I said before, a big tailwind for the retail real estate investment trust space is higher interest rates, which is going to raise their cost of capital, right? So how much is it actually going to raise it by? Well, it's going to raise the cost of debt. That's the one I want to focus on for this. And it doesn't hit, it was an impact, but it wasn't a massive impact. We can see here, previously it was 3.16%. Now it's 3.78%. In terms of their mortgage payable, it didn't actually increase that much, just 40 basis points. And then 40 basis points in their largest form of debt, which was their notes payable here. Where the largest increases were was in their commercial paper, where their interest rates went from under 1% to where they are now at about 4.5%. So again, I just wanted to highlight that because for one, it shows the actual difference and it allows you to actually quantify it. So instead of just, you have the general knowledge, that if interest rates go up, it's going to be harder for REITs to perform well. You can actually quantify it and make, specific investment decisions as opposed to just speculating and saying, all right, I'm getting off of REITs now because rates are going up, right? How much are they going up by? How does that impact the specific real estate investment trust that you own? What's unique about them? Do they have a lot of fixed debt? These are the types of questions that you can ask. And if you're asking those questions and actually analyzing these REITs specifically, you learn a lot of interesting things. And I think we've learned quite a lot about Realty Income from this. Okay, so last thing I want to cover in this video is, as promised, I want to do a actual valuation of this company using the value of stock feature here of Realty Income. Now, I want to keep this super brief and super high level, not getting too into the weeds on anything because, normally when I do these valuations, they are talking about them. It is a little, repetitive, a little boring. This tends to be the part of the video that I see people click away from. So I'm going to keep this just very short and to the point and not explain anything too much. But using the DCF method for a real estate investment trust, we do have to make some slight adjustments to get it to work because these companies do have some unique features, and there are some inputs that we would have for normal companies that don't really, apply to REITs, but we can still make it work. So let's just dive right in. The first thing I'm going to do is I'm going to change the revenue growth. So this 23%, it's based off of the historical 5-year average here. This accounts for the growth in their actual assets. So growing rental income by acquiring more assets. For the sake of this DCF, I'm going to assume that they don't acquire any more assets, right? It's what they're worth as of this point in time right now. So with that, we can probably assume that they can increase their rents by about 3% per year, right? So roughly about what inflation we could expect it to be. Now, the operating margin, REITs don't really report operating margin, but you can calculate it. I mean, they do have operating expenses, they do have rental income. For this, I'm just going to use a more normalized figure and go a little bit more conservative at 40%. They do have a tax rate because they do actually pay a little bit of taxes. I'll leave it at what it's been historically, about 4.5%. These capital expenditures include both the capital expenditures they need to maintain their properties and also the capital expenditures, which would be acquiring new investment properties as well. So we don't want to include the new investment properties. Again, we're trying to calculate what they're worth currently, assuming they buy no more investment properties for the rest of time. So I'm going to drop this to about a fourth about 1/10 of what it was before, so about $410 million. And that's how much we're assuming they're spending each year to just maintain their asset base, right? Not expand it by acquiring new properties like the Bellagio or anything like that. Depreciation amortization, I'll leave that what it's been historically. I'll change working capital investments to zero, changes in shares to zero. The cash and investments balance I'll leave the same. And this we have to actually, the debt and capital leases, we have to increase this a bit because we calculated it before and it was about $19.5 billion. So those are our assumptions there. In terms of the terminal year multiple, this is a multiple of EBITDA. Again, you don't really use EBITDA when you're looking at REITs, but you can calculate it. I mean, just like you would with other businesses. And I looked at what it has been historically, and it's kind of been in the range of 20 to 22 for this company. It fluctuates a bit, but it's usually around there. So I'll just put in 20. And then the discount rate, we know the cost of capital because we calculated it before, is 4.95%. All right, so those are all our inputs, and we'll calculate it. And we can see it's still slightly overvalued at this price. We get an intrinsic value of 49.05 and then a current price of 55. Now you may be thinking, well, what about, why did you assume that they're just going to not acquire any more properties? Well, you have to consider when they acquire a property, right? Yes, they do gain that asset, but they usually pay for it with debt. So in a way, it's like a net zero transaction, right? It becomes a net positive transaction if the future rental income that they earn exceeds the cost of capital they had to pay to acquire that asset, right? So going back, to this calculation here, this golden calculation here, this is what it all comes down to. And when I was doing this calculation, I just wanted to keep things simple. It's still a valid calculation. Some people are obviously going to have different assumptions and different inputs. But yeah, that pretty much does it. I hope you guys did find this analysis useful and you learned a bit about REITs and you learned something about Realty Income as well. If you have any questions about this, feel free to drop it in the comment section. And yeah, that pretty much does it. So thank you so much for listening, and I'll see you guys in the next video.